It wouldn't surprise me if 10 years from now, the price of gold was $10,000 or $12,000 or $15,000 US. Price leadership changes from gold to silver. With regards to some of silver's uses, specifically as a germicide, water treatment application, reflectivity, its utility to the solar industry, it will be hard to replace. It's going to take a very high silver price. But if you had $150 silver, that whole thing changes. The Chinese have always bought most of their silver. The Chinese silver production is mostly a consequence of their lead and zinc byproduct metal. The other thing that could change silver supply dramatically, the increase in a sales or excise tax in India, which is the largest retail silver market on the planet. Nominal interest rates are rising, real interest rates are rising. You'll notice that even in the United States, where short-term interest rates are being manipulated down, the market has taken control of the long rate. Despite the fact that the bank rate falls, the 10-year rate has increased. The bond vigilantes are back in business.
Where do you see gold, silver, let's just say even platinum, palladium, even perhaps rhodium going? If we are in a bull market, what stage are we at, and how long do you see this bull market going?
I see the purchasing power of the US dollar declining for 10 years. And hence, I see the nominal price of gold increasing for 10 years. I say nominal because I refer to the US dollar quoted price of gold. I suspect, although I don't know, that the increase in the nominal price of gold will mirror to some extent the deterioration of the purchasing power of the US dollar price of gold. I was recently in London, and I had occasion to be on Seville. And it's been said for my whole lifetime that an ounce of gold will buy you a very fine men's suit. Surprise, surprise. A men's suit, tailored men's suit on Savile Row is approximately $4,100 or $4,200 US. It wouldn't surprise me at all if that same suit 10 years from now was $12,000 or $15,000 US. It wouldn't surprise me if 10 years from now or so, the price of gold was $10,000 or $12,000 or $15,000 US. In other words, the price of gold will be no higher in terms of purchasing power, but it will maintain its purchasing power. Well, the US dollar will decline in purchasing power.
The dollar's long-term slide is quietly setting up gold for a decade-long rally that few mainstream investors fully grasp. Over the past 10 years, gold has maintained purchasing power even as the USD weakened, and this alignment could repeat. The reference to a Savile Row suit costing $4,200 today versus $12,000 to $15,000 in a decade underscores how gold tracks real-world value, not nominal USD price. Nominal prices may appear dramatic, but purchasing power is what truly matters for wealth preservation. This context is crucial for portfolio planning. Next, he outlines how silver could outpace gold in this cycle.
If past is prologue, Patrick, and I can't guarantee this, but if past is prologue, there has come a time in every prior bull market where when the generalist investor is attracted to the space because of the momentum in the gold price, price leadership changes from gold to silver. And we've, in fact, seen that in 2025. I think the increase in the silver price has been about double the increase in the gold price. This is consistent with prior bull markets. And if the realization and the acceptance of the narrative around gold continues, I would suspect that silver will continue to outpace gold. As to rhodium, I think that has a lot to do with the strength of the economy and the utility that rhodium demonstrates relative to its price. It's a minor metal, and I don't speculate in it. I'm afraid of it. I have been a bull on platinum and palladium because I've seen their price weakness, which I think was due to Russian dishoarding. You know, the Russians have had another need for cash for the last 3 years. And to the fact that investors around the world are forecasting the demise of the internal combustion engine, and hence less need for catalytic converters. I believe that the internal combustion engine will continue to be the primary form of individual transportation in the world for 20 years. And I think as a consequence of that, that platinum and palladium demand will continue to be relatively good in the face of potential supply disruptions in each of Russia, Zimbabwe, and South Africa.
Investors often chase gold's momentum without noticing when silver historically takes the lead. In 2025, silver gains were nearly double gold's, reflecting prior bull market patterns highlighted by experts. Platinum and palladium remain structurally supported by ongoing demand for internal combustion engines, despite global EV narratives. Russian supply disruptions have already tested these markets, yet demand persists. For portfolios, ignoring silver or PGMs now risks missing critical upside in metals outside gold. Next, Rick Rule addresses how high metal prices trigger fabrication changes.
So I'm bullish gold, I'm bullish silver, I'm bullish platinum and palladium, and I can only barely spell rhodium, so I have no opinion.
Yeah, the reason why I wanted to ask that also was because, sure, the PGM group of metals, they do look to be they do look to rise. Silver looks to rise. Gold looks to rise. But especially with, let's say, silver and platinum, do you think we'll come across the point where we see demand destruction, where it just becomes too expensive to use in everyday products, goods, and services?
Yes, I do. There will be a point in time when there will be substitution in fabrication. Now, in fairness, with regards to some of silver's uses, specifically as a germicide, so water treatment applications, but also its reflectivity, its utility to the solar industry, it will be hard to replace. It's going to take a very high silver price. What will happen over time with silver is that technologists and fabricators will find ways to utilize silver more efficiently. Its reflective properties are so extraordinary that the utility that silver generates relative to the cost of silver that goes into a solar panel is quite low. But if you had $150 silver, that whole thing changes. You need to find a way to use less silver in the fabrication process, or use a silver alloy or a material that, while it's a little less reflective, is a little cheaper.
High silver prices won't instantly curb demand due to its unique industrial roles. Germicidal applications and solar reflectivity mean replacement is tough, even if prices spike toward $150 NOS. Technologists adapt slowly, optimizing efficiency rather than outright substitution, but costs in fabrication rise. Investors should consider this subtle demand resilience when evaluating silver exposure in portfolios. Supply constraints and efficiency gains will dictate market moves more than headline price. Coming up, Rick Rule explains how global supply chains shape silver availability.
China's going to start next year, January 2026, where they're going to start limiting their exports of silver. So just kind of wondering your take on that and how that may push the silver market.
I think that's a non-event. The Chinese have always bought most of their silver, and occasionally they've bought silver from elsewhere, China being the largest silver producer in the world. It's important to note, Patrick, that primary silver production, which is to say silver produced from silver mines, is about 20% of total worldwide supply. The rest comes from recycling or as a byproduct from other metals. The Chinese silver production is mostly a consequence of their lead and zinc production, byproduct metal. And I don't think that the decrease in the supply of silver, export supply from silver, will make much of a difference. Certainly not enough to offset investor demand. What will make a difference in silver supply one way or another is paradoxically the copper price. When I was in London, I heard, and I don't know if it's true, I heard that the copper mining industry expects to have to spend $250 billion over the next 10 years replacing copper supplies. If the copper price isn't high enough to incent that, you are going to see copper production fall dramatically. And the consequence of that is that you're going to see byproduct silver fall dramatically. Conversely, if current copper production can be maintained, or if it can be increased, I think that you'll see increased byproduct flows in silver. So I think that what investors need to do is pay much more attention to funded investment plans in the copper business and the zinc business, and to a lesser degree in the gold business, in terms of forecasting silver supply.
Chinese export restrictions often make headlines, but real supply shocks come from byproduct metals like copper. Only 20% of global silver comes from primary mines. Recycling and byproducts dominate. A $250 billion copper investment gap could have byproduct silver, if unaddressed, directly impacting industrial supply. Investors need to follow copper and zinc capex closely rather than reacting to media chatter on Chinese exports. Up next, Rick Rule highlights how India's market taxation influences global silver flows.
The other thing that could change silver supply dramatically would be the imposition of a sales or excise tax, or the increase, in a sales or excise tax in India, which is the largest retail silver market on the planet. To the extent that the Indian government began to disincent silver ownership, then I think that you would see a marked decrease in Indian demand. Now, understand, the Indian smuggling community is extremely efficient. And if the tax in India gets too excessive, the supply won't diminish much because the smugglers are ruthlessly efficient. And by the way, you in Singapore, as silver dealers, would benefit immensely. To the extent that there was no excise tax in Singapore, but there was in India, more Indians would choose to buy and hoard their silver in Singapore than in India. And that would be, I would suspect, of distinct benefit to you.
India's silver taxation is more about incentives than shortages. Even if the government hikes excise duties, the highly efficient smuggling network mitigates supply shocks. Singapore benefits as a nearby safe harbor for bullion, potentially drawing Indian buyers and raising regional demand. For investors, the interplay of policy, smuggling, and cross-border hoarding must be tracked to understand price movement, not just headline consumption figures. Next, Rick Rule will explore how global macro forces influence precious metal allocations.
With silver, it recently moved into the critical minerals list, I believe, for the first time. What were your thoughts when you first heard it? And shortly after, I think we saw China looking to limit their silver exports.
American politics never ceases to amaze me, despite the fact that I am an American. The whole concept that the United States government has decided to invest in mining astonishes me. I don't personally need Mr. Trump to manage my investments. I would prefer that he stayed away from me. I would prefer, too, that the United States organize its economy around market forces. I want as little federal nexus in the mining business, in the commodities business, and in the oil and gas business as is possible. The Arabs say if you allow the nose of the camel in the tent, pretty soon the whole camel is in your tent. It is that way with the U.S. government and any other government. What is positive about it, I think, is that the popular zeitgeist in the United States, the public will, has changed to the extent that the government can do this.
The headlines trumpet government involvement in mining as progress, but the reality is far more nuanced. US federal investment into commodities and mining may seem supportive, yet it risks distorting markets and incentivizing inefficient capital allocation. Only 5% of critical metal supply chains are truly strategic, yet policy changes grab investor attention disproportionately. As Rick Rule emphasizes, minimal government intervention usually fosters more sustainable growth. The shift in public sentiment may create a short-term funding boost, but seasoned investors know hidden costs lie ahead. Stay tuned. Rick Rule's insight explores who really benefits from government subsidies.
5 years ago, as a mining investor, as a natural resource investor, I was vilified. I sort of expected to see my picture on a post office wall. Now these morons want to subsidize me. Patrick, I have to tell you, I felt cleaner as a human being when they vilified me than I do now as an investor when they subsidize me. But the interest, I guess, of historical natural resource investors like myself is that when the industry is in need of capital, it is to the interest of existing investors to attract dumb money to the sector. And there is no dumber money than the government. So while I think that the intrusion of the government into metals and mining is a net negative for society, it's a net positive for me because they lower the cost of capital.
Government subsidies in mining aren't about efficiency. They're about cheapening capital for current investors. While public criticism 5 years ago created reputational friction, today the same government funding reduces financing costs and attracts inexperienced capital. Historical data shows that when government enters niche sectors, it temporarily inflates valuations without improving fundamentals. As Rick Rule and other natural resource experts note, seasoned investors benefit while policy risks remain hidden. The takeaway: understand who gains and who pays before chasing subsidized sectors. Next, Rick Rule discusses shifting asset allocations away from traditional portfolios.
I saw something opposite here where, we hear the words dollar debasement, de-dollarization, deglobalization trends, and we hear central banks purchases looking to continue. And I've been hearing on where some money managers, anyway, are moving away from the recommended traditional 60-40 structure toward asset mixes incorporating as much as a 25% commodity exposure, which is a shift that structurally increases the demand for gold and silver. So what are your thoughts on this?
Well, certainly any investor on the planet who believes in a 40% portfolio in bonds, at least long bonds, needs his or her head examined. Bonds were a wonderful place to be in the 1982 to 2022 timeframe, when interest rates relative to the deterioration in fiat currencies were fairly strong. Nice place to be. But that game's over. Nominal interest rates are rising, real interest rates are rising. You'll notice that even in the United States, where short-term interest rates are being manipulated down, the market has taken control of the long rate. Despite the fact that the bank rate falls, the 10-year rate has increased. The bond vigilantes are back in business.
The 60-40 portfolio is becoming obsolete as bond yields fail to compensate for inflation and real interest rates climb. Money managers are increasingly allocating up to 25% to commodities, structurally increasing gold and silver demand. From 1982 to 2022, bonds were a low-risk hedge, but today's long-duration instruments are vulnerable to rising nominal and real rates. Investors ignoring this shift risk? Capital erosion. Central banks are also adapting, signaling that market forces now dominate over policy manipulation. Next, Rick Rule explains why long-duration bonds are particularly dangerous.
So anybody who owns a bond in duration longer than 5 years, if it isn't a floating rate bond, is crazy. The long bond, as Franz Pick described it, is a certificate of guaranteed confiscation. You're gonna lose money there. That's just a fact. For central banks, I think they've come to that same conclusion. The arithmetic around owning euro-denominated instruments or dollar-denominated instruments in the 5-year time frame is lousy. And buying gold also obviates the politicization of the U.S. dollar. The tendency of the U.S. dollar to extraterritorialize its policy perspectives through the SWIFT banking system or, in the case of the Russians, through the confiscation of $300 billion worth of Russian-owned U.S. bonds. I think paradoxically, the U.S. government is giving foreign central banks no choice but to buy gold. The subtext away from the United States is that to the extent that foreign countries trade with each other in dollars, they give seigniorage to a government which increasingly they feel is their enemy. And while they don't trust the US, they seem to trust each other less.
Long-term bonds are effectively traps in the current macro environment. As highlighted, euro and dollar-denominated 5-year instruments provide negative arithmetic returns once real rates and political risk are considered. The confiscation of $300 billion in Russian-owned US bonds exemplifies how foreign policy and currency politicization directly affect portfolios. This dynamic forces central banks to shift toward gold as a neutral store of value. For global investors, this underlines the intersection of geopolitics and asset allocation. Next, Rick Rule examines how trading in local currencies, combined with gold, reshapes reserves strategies.
One can understand from a Chinese perspective, the last thing they want to do is end up with a great big pile of rubles, or reals, or pesos, or even yen. And I think what those countries would prefer to do is trade with each other in their host currencies and then convert the surplus to gold, a medium of exchange that's simultaneously a store of value. And I think that in addition to the fact that owning U.S. Treasury securities is simply bad math, has been responsible for the disintermediation of foreign central bank holdings away from U.S. dollar-denominated securities and into gold.
Foreign central banks are quietly rewiring reserves to avoid currency risk, converting trade surpluses into gold rather than dollars. This is more than hedging. It's a structural shift driven by distrust of US policy and poor Treasury math. With local currency trades, countries like China mitigate exposure to volatile foreign assets, reducing dependence on dollar-denominated instruments. For investors, tracking these reserve flows offers foresight into precious metals, demand, and long-term currency dynamics.